waiting. I'm told that we have him with us right now. Ajay, if you can hear me, there I can see Ajay there, Head Investment Strategy and Advisory at Prabhudas Lilladher. Ajay, if you can hear me, have you been following whatever has emerged on this Infosys story?
Yes, I have been following, and I think I would tend to agree with both Mr. Bala and Mr. Mohandas Pai that with such a large hoard of cash that the company has been carrying in the balance sheet for years, with the ostensible purpose of doing an acquisition, a large size acquisition, which has not been materializing. I think the return ratios are getting diluted to a large extent with this cash which is earning paltry returns. And hence I think the course of action that has been suggested by these eminent people who have served in Infosys in marquee roles, I think I would tend to wholeheartedly agree there that the company either needs to go in for a one-time large dividend or a buyback in case the company does not have an acquisition on the anvil in the near term. I think and that is a practice which is being followed by a very large number of companies in various sectors in the developed world. If you do not have a means of utilizing that cash for purposes of growth for the business, I think you need to buy back the shares or return the cash to minority shareholders, to all the shareholders, as dividend.
Okay, I'll first ask about your choice. If you had to choose, which one would you go for? Buyback or dividend? Which one would you prefer?
I think I would prefer buyback because that sort of would send a very positive signal to investors.
Buyback will send a you were mentioning that unless there is a clear plan with an acquisition with a clear acquisition target, do you feel that the Nifty management needs to, the Infy management needs to come out and clear the air now that this is in the public domain? They need to make some kind of a statement that yes, we have an acquisition target. We might not give you exactly what it is, but we need this cash for that, or else yes, we are planning to give you some cash back.
I think either way, the company has to spell out in no uncertain term, because this issue has been bubbling under the radar for years on end. And all of us have been expectantly waiting from the management about the utilization of this cash hoard, which only has been growing over the years. Now, assuming that the company needs to squirrel away a certain amount of cash for unforeseen circumstances when the global markets are not doing well. But today, if you look at the scenario, I think the US in second quarter has grown at 4%, its GDP. You are seeing the other, and the US contributes a substantial part of Infosys' revenues. So the economy is clearly over the hump. Europe, the other large contributor, also has come out of recession. UK, I think, economy is going great guns. So I think now that the problems in the large markets are behind us, and the company has in place a very strong CEO, who is globally respected, I think the company needs to come out strongly about what it needs to, what it would, intends to do with the cash. And as you rightly said, if there is an acquisition in the sites, do not obviously hint, but at least spell out the timeline by which the acquisition you intend to do the acquisition, or you spell out that you would like to go in for a buyback.
One final question on Infy before we move on to other issues with you. Do you see anything in the space where there can be synergies with Infosys, where an acquisition will help push the company forward from where it has gone down?
I think I agree that again you'll have to look at focused acquisitions on what verticals the company wants to grow. Or there are certain geographies that the company has missed out on. So I think the company will have to examine this issue. But to be fair to the company, there has just been a change in management not too far back. We need to give at least a quarter to the new CEO, who is globally respected, as one of the thought leaders and opinion makers in the technology world. And all the investors are looking forward to what kind of turnaround plan does he script in the medium term. So people have a lot of hope in Infosys. We are extremely positive. In fact, Infosys figures along with Tech Mahindra and Wipro as among top buys in the large cap space and KPIT in the mid cap space for us. Our analyst is expecting that in the medium term, 12 to 15 months, a price of around 4,040 rupees in Infosys. He is penciling in around 8% revenue growth this year, 12.4% revenue growth next financial year, and an earnings growth of around 14.8% in FY15, followed by around 12% in FY16. And with the current ROEs of around 22.4% in FY15, expected to grow to 24.4% in FY16. I think the stock at 14.7 times FY16 looks very attractive. But as I said, the ROEs are clearly depressed because of this massive hoard of cash that the company is carrying on its balance sheet. If it were to buy back or return the cash in dividends, the ROEs will spike up and the markets will appropriately recognize that by according a higher multiple.
Ajay, let me go to the broader market, to the overall headline index, let's say the Nifty. Now, there has been talk that the Nifty is ripe for a correction. Some are saying it will go down to about 7150, but we're not really seeing a correction. We've seen some sort of sideways consolidation. But if you look at the chart, 7450 seems to be very, very strong. Do you think that it will correct beyond that, go below 7450 at all?
I think I would believe that the Nifty in the short to medium term would move in a channel. On the upside, I think 7800 looks a level difficult to breach decisively. On the downside, 7450 looks an extremely strong base or a support level. And unless sort of something very negative were to suddenly emerge in global markets, I don't think that that level of 7450 is likely to be breached anytime soon. And I'll give you 4 or 5 reasons. One, I think, if you look at the retail inflation, it has come in at a 30-month low of 7.31%. If you look at WPI in the month of June, it's at 5.43%. It's come down after a 5-month high. And the IIP clearly looks to have bottomed out based on the improvement, slight improvement in the May figures that we have seen in capital goods, mining and power sector. It's at a 19-month high of 4.7%. So I think inflation clearly looks to have trended down, and the 2 main worries that the market was concerned about, one was the spread and the quantum of monsoons, which has sort of so that deficiency has come down to just 21% this week, vis-a-vis 29% last week, and out of 36 subdivisions, only 17 today are normal subdivisions and 19 are deficient. Just a month back, only 7 were normal, the others were either deficient or scanty. And the sowing season is proceeding extremely well. Today, I think the sowing is down only 14% YOY. This week, vis-a-vis 29% last week. And major crops like rice, sowing is only down 7%. Pulses, which are down 90% last month, has down only 21%. Sorry, oilseeds, I mean. And pulses is down only 15%. So I think overall, these 5 factors, as I mentioned to you, clearly give a comfort to the market that the downside looks like limited, and the market will move in a channel.
And if one had to look at the correction, and you said that 7450 is a very, very strong support, what do you think will lead that correction at the moment and would get to valuations, sectors which would get to valuations where again they'll look attractive at about 7450?
See, now that we're in the midst of the result season, what is happening is people are not taking a broad sweep in terms of a call. They're looking at specifically bottom-up approach, and whichever companies in whichever sectors are delivering better than analyst expectations, they are being rewarded, and wherever it appears that the management has not been able to meet market expectations, the stocks are getting punished disproportionately. I'll just give an example to you. Just 2 days back, I think Cummins India had a conference call in which the management gave an extremely robust outlook. They said that they upped the guidance from 5% to 10 to 15% for FY15, with exports leading the charge at 30% growth in FY15, albeit domestic remaining tepid at around 5%. And the granularity they explained, which of the subsectors that they cater to in terms of process industries, they are seeing the early signs of growth. And the market rewarded the stock handsomely over last 2 days. At the same time, there are certain other companies in the same sector where the earnings were a tad below expectations, and the market was unrelenting in terms of punishing the stock. So we'll have to approach every stock on its merits rather than taking a broad sweep about a sectoral call.
For Cummins specifically, what kind of multiples would you give it? Because some of the calculations that we were making based on this renewed guidance gives us an adjusted EPS of about 26 odd rupees. So what kind of multiples would you feel comfortable with? And does that sit broadly with your own calculations?
Yeah. So I think Cummins closing yesterday was around 671, and our capital goods analyst has predicted a 1-year target of around 745 rupees for the stock. He is penciling in basically a revenue growth of 10.9% in the current financial year, followed by 17% in the next financial year, which will basically boil down to an earnings growth of 12% in the current financial year and 20.3% in next financial year. So the ROE for the company is at a healthy 27.5% this year, followed by around 25% next financial year, and ROCEs of around 25% this year, followed by 27% in next financial year. So it is trading at 23 times FY16 earnings.
23 times FY16 earnings. So that's what you're looking at currently.
Yes, and we are expecting a target price of 745 in 12 to 15 months.
All right. Can you give us some calls on, let's say, I understand that you're giving in capital goods as well. I would like some sense from the auto and auto ancillary space as well. Are you tracking Maruti?
Certainly.
And also Hero MotoCorp. The numbers came out yet. Are slightly disappointing.
See, in two-wheelers, our analyst's preference remains with Maruti Suzuki. He basically is expecting a target price of 2816 in the medium term, which is a 1-year perspective from the current 2666, I think. And the numbers is penciled in essentially a revenue growth of 13.3% current financial year, followed by 19.4% in next financial year. Earnings growth of 23% current year, followed by 34.2% in FY16. A very strong earnings growth is predicting. And ROEs of around 14.4% this year, followed by 15.7% next financial year. And the stock is trading at 17.5 times FY16 earnings. Talking about auto ancillary, I think we are very positive on LG Balkrishna. In fact, I have been advocating investors to look at it from a holding as a core holding in their portfolio with a medium-term perspective. A very strong presence in automotive transmission segment, one of the largest suppliers to Bajaj Auto and HMSI for auto transmission products. They are also there in metal forming. The companies, I think we are expecting a target price of 600 rupees in a year and a half from now. We are expecting a 14.5% CAGR in revenue growth from FY14 to FY16 and a 48.2 rupees of earnings current financial year. Next financial year, 58.3 rupees, a 20% growth roughly. The company's ROE is expected to grow from 20% FY14 to 21.5% current year to around 23% next financial year. And the stock is trading at 8.4 times FY16 earnings. The other stock in auto ancillary that we have been positive for last 1 year and we continue to remain positive is Motherson Sumi. Here I think not only is the company having a strong position vis-a-vis supply to Maruti Suzuki in India, they have a 4 billion euro strong order book in Europe and the largest suppliers to some of the marquee names out there like Volkswagen. They also have done an acquisition in Mexico. We are expecting a target price of around 400 to 420 in the short to medium term there. And there we are penciling in a revenue growth of 18% current year, followed by 17% next financial year, boiling down to a PAT earnings growth of 29% this year and a healthy 38% next financial year. So the stock has an ROE of around 37%. And we are expecting it's trading at a PER of 18.7 times. Also, I believe Crompton, I think there was some disappointment yesterday vis-a-vis the expectations, but I think the management has been able to allay those concerns in the conference call that happened post-market, and I think the stock has had a good reception today. So Crompton again the consumer business in India and the power business in European markets would clearly lead the charge followed by obviously the power business in India, and then the industrial business in that order. So there we are expecting a target price of 225 in the medium term, and penciling in around a very strong earnings growth of 35% next financial year. And we expect the stock is trading at 18.8 times.
Right. Ajay, thank you so much for joining us. Pleasure having you, and thank you for giving us all those detailed ideas. Maruti Suzuki, Cummins, LG Balkrishna, Crompton Greaves, Motherson Sumi. Thanks a lot. Pleasure having you. We hope to have you back soon. Okay, we have to take a very short break. After that, we'll have the management of Syntex joining us. But we also want to leave you with two sound bites from Vishal Sikka, the new CEO of Infosys. Prashant spoke to him and asked him about the pressure, whether he feels any pressure stepping into these shoes, and whether there's too much pressure expecting him to perform way beyond whatever Infosys has been performing in the last 3 years. Let's listen into those.
No, I think that it is very early, and so I think everyone understands that, first of all, the fundamental nature of the services business is such that no matter what initiatives we take now, they will take some time to show effect. I mean, things that we are seeing now are the results of actions that have happened over the last several